And hello, everybody. I told you I would be back down on the trading floor, and here I am in the very quiet S&P 500 option pit as we speak. S&P's up 9 points. We were just above 7,000. We're at 69.96 right now. What else do I have up here? Bitcoin is down 1.5%. NASDAQ is up 150 points, or 2/3 of 1%. The Russell is down slightly, and the VIX is up a little bit. VIX up about 20 basis points on the day. How is everybody doing? How is everybody doing? Yep, high on the day in the S&P 7,006. All right. So, if everybody can hear me okay, we are going to get started. Let's do it. Smash away, like, subscribe, all that good stuff. And based on my question to everybody yesterday about what you would like to talk about today, we are going to talk about diagonals and calendars. When to use which one, what are the differences, what are the benefits. And actually it's pretty good discussion today, especially because we just put one on, we put a diagonal put spread on in STZ, in our calendar call spread that we have in Datadog right now, which is doing great, but the stock just flew past our short strike. What do we do? How do we manage? So which one? What do we do? Right? What's a diagonal? What's a calendar? Well, they really have the same concept. They're both called time spreads. Okay. The difference between the two, as many of you know, is that a diagonal has two different strikes. So a diagonal is a combination of a calendar spread and a vertical spread. Okay. And can everybody hear me okay? Just waiting on that response there just to make sure sound is good. Okay, excellent, excellent. So the calendar, with the strikes being the same, is a little bit less aggressive of a trade. What does that mean? Well, a diagonal is going to give us more directional bias, more bias either on the upside if we're doing a diagonal call spread, like what we did in SBET this morning, or on the downside on a diagonal put spread, like what we did in STZ this morning. Okay, so a diagonal is always going to cost a little bit more because you're adding that vertical nature of the spread in there, as opposed to the calendar where the strikes are the same. Both of them completely risk defined. Both of them have typically a pretty low cost basis to it. And you'll see here, one of the points that I make here is the long option typically has that further expiration. Now, you can set up a calendar or diagonal with the short option being the further expiration. However, we don't do that. The reason we don't do that in either scenario is because of the capital requirements for that. Because if we have an option that expires further out than the one that we are long, so the short option expires further out, the way that your brokerage firm treats that from a margin standpoint is that you have a short option. Don't. All right, hang on, guys. I am frantically trying to, there we go, set up my monitor there. Okay, we got it. Okay, not good. Does everybody understand that, why we don't sell those calendar or diagonals, even though you could? You know, if your account size is big enough, there definitely are opportunities for that. We just don't do it because of the margin. Okay, so let's talk about diagonals first. Okay, diagonals are like vertical spreads. Okay, two different strikes. Whoops. two different strikes, okay? And we want a stock to move, right, in the money. Ideally, we want it to move in the money. Okay, so like what we did this morning in SBET, we want stock to move higher. What we did this morning in STZ, we want the stock to move lower. So the maximum value, the max profit of a diagonal is not just the width of the strikes like in a vertical spread, but it also adds in the remaining extrinsic value, the time value of the long option. Okay, so it's a vertical with additional extrinsic value. Well, Kevin, being short a diagonal just means that your short option is further out than your long one. Now, if you already have another option that you own that is longer out, further expiration, okay. Okay, now, since there is that time difference on both a diagonal and a calendar, okay, we have some things that we can do to adjust those positions if need be by rolling. It can roll out a different strike. You can roll out to another expiration, like what we're trying to do in DDOG right now. Okay, now in our SBET, and actually let me go to that right now. Let me show you what we did in our diagonal SBET this morning. And SBET, here you are. Okay, here is our position in SBET. And as you can see, we are short the 12 call that expires just in a couple weeks, long the 10 call that expires over a month out. So we have the time consideration, we have the time spread, and we also have the vertical. So even though we look at this and say, hey, the strikes are only $2 wide, this can absolutely be worth more than $2 because of the extrinsic value, because of the time value of the long option. So if I just put up our P&L graph on this here, what you will see is this is a pretty bullish spread. It's basically like buying that 10 strike call out in February and hedging it a little bit by selling the 12 strike call out in a couple weeks. And ideally, what is the best thing to happen? Okay, here's what this P&L looks like. What is the best thing to happen here? What's up, Denny? And hint, hint, hint. Same thing as we want to happen with every position. That's right. Go to the short strike at expiration. Again, and that gives us the option, no pun intended, of rolling, closing, collecting more premium. Okay. Well, Bear, that all depends, right? That all depends on the situation. SBET was not based on volatility. Okay, there's no earnings, there's no anything else. I'll go into DDOG in a second, which is a calendar. We'll do that in a second, but I want to show the STZ diagonal put spread. Okay, so SBET was not done for earnings, really not a volatility play. Part of why we did STZ was because of earnings and was because we are selling incredibly high volatility this week, buying cheaper next week. So here is the position. You can see we basically have the 135, 133 put spread, but two different expirations. So again, just like on the call diagonal example, this can be worth more than $2 because of the extrinsic value. That's right, Kevin. So many options with options. So what we need to do in the case of earnings, which STZ is, when we know there's going to be that earnings crush, we have got to make sure that we account for that, which we did here. So you can see the adjustment that I made here, lowering this week's implied vol. And you can see the adjustment. If I can, okay, there we go. Lowering next week's implied vol as well. Got to make sure we always take that into consideration. Okay. So in summary, on the diagonal, on a long call diagonal, okay, time spread, calendar spread, vertical. And that long call is going to be a lower strike than the short call. The beauty on these, both calendar and diagonal, when you do it this way, when you set it up with the long option being the one further out, you always know what your maximum risk is. You always know what your maximum potential loss is. Now, what we don't know is what the maximum potential gain is. Why is that? And no, it's not in case the strike price and the call won't work out, we do the put. No, we definitely have a bias directionally when we put one of these on. So in SBET, where we did the diagonal call spread, we're doing that because we're bullish. In STZ, where we have the diagonal put spread, we did that because we are bearish. Okay. So why can we not tell? Why can we not tell what the maximum profit would be? Yeah, one option, the two options don't close at the same time. So what if the short option closes, out of the money? So it's worthless and we're left with our long option, and then anything can happen. Okay, so good one on that. Okay, now long put diagonal summary. Same thing. We want that long put to go in the money. We want that long put to go in the money. Same as on the call side, what you pay for it, as long as the long option is further out, that's your maximum risk. Just think Starbucks. Just think Starbucks. Right, Robert, that exactly happened. That you're exactly right. We had either a calendar or a diagonal. I don't remember what it was, but the short expired worthless. And then we came in on Monday the following week or Tuesday and the stock exploded. Exactly right. Okay, so here's what P&L graphs would look like for both a diagonal call and diagonal put spread. Okay, so what these peaks are that you see right here, yes, that's the short strike. That's always going to be where the highest potential profit is while both options are still alive before one closes out. And the same with the diagonal put spread. Short strike is always going to be where the maximum potential profit is. Now, what you'll notice here before we get into the calendar is even if we get way past the strike. So on the call side, if the stock flies higher, or on the put side, if the stock tanks lower, we're still going to win. Okay, you're still going to be profitable because you have that vertical nature of the spread, which is not the case in calendar spreads. And before we go to the calendar spreads, let's get to, yeah, little Lou is wearing some shades. Little Lou is going to Florida tomorrow, so her mama and papa got her some sunshades. Let's go, Lou. Wow, is it quiet down here? It is really, really quiet down here. Okay, we'll come back to Lou in a little bit. So, as a review with diagonals, okay, diagonals and calendars, they both work great for time decay because you're taking advantage of the time decay in the short option, which is going to accelerate and lose more value quicker than the long option. Okay. And how does volatility affect diagonals or calendars? And this is actually one of the reasons why we did put on the position we did in Datadog. Okay, what is a in a situation where we're not looking at extended implied volatility because of earnings, being long that volatility, long the further out option gives us increased exposure to a change in volatility or positive vega. So it's an ideal type of trade when volatility is really, really low. Okay, now talking about calendar here, same thing as the diagonal, but we are just using the same strike. Okay, reasons why you do a calendar versus a diagonal. Well, it's not as aggressive, meaning that the delta is not as biased, either long or short, because we're looking at the same strikes. So because we're looking at the same strikes and we don't have that vertical nature part of it, okay, we are looking at a spread that costs a lot less. Calendars will always cost less than a diagonal. Okay. Same rules apply in terms of you can buy them or you can sell them. We don't sell them because if we sell them and our long option is further out than the short option, we are going to get hit with massive capital requirements, margin, because your brokerage firm is not going to like that. Okay. And as I have on here, a calendar spread is one of the lowest type of capital requirements that you could ever put on in terms of what sort of margin you may need for your position. Okay, does everybody understand that? Okay, so again, what are the advantages here of putting on a calendar spread? Think of it again, the thesis behind a calendar and a diagonal, everything is the same except for the strikes. The only outcome that changes is how much a stock may move, and that's you have the vertical spread on the diagonal, you have just the same strikes on the calendar. So with a calendar, you're still going to have that positive theta decay because that nearer term option that we have sold is going to decay quicker. We always want a stock to gravitate towards that short. And an increase in implied volatility is very good for this type of trade. Now, what do I mean by that? Well, let's look at our Datadog. Okay, let's get to Datadog here. We want this thing to stop moving, right? Let's pull up this implied volatility. Okay, does everybody see the implied volatility chart in Datadog here? Okay, So that point that I just highlighted, that is where we entered into our trade. Remember, this is not stock chart. I'll show you that in a moment. This is not a stock chart. This is the implied volatility chart. Well, with implied vol down here, I want to put something on that gives me exposure to the potential of implied volatility increasing. Does that make sense to everybody? And you can see in just the 3 or 4 days, whatever it is that we have had this position on, there's been a pretty significant increase in implied vol. Why does that help our position? Because our long option has more vega or more volatility sensitivity to a change in implied volatility. So any uptick in implied vol absolutely helps a long calendar or a long diagonal spread. Now, why did we do a calendar call spread, not a calendar put spread? And that is because that's right where we put it on. That stock came right down to the 200-day moving average. We were looking at that as support. So we got the double whammy there. We got support in the stock and big time support in the amount of premium or volatility. Okay. Everybody understand that? So that was an instance that we really, really were able to take advantage of. A, stock being at support, looking at something bullish, and B, volatility being so cheap and at support, looking at something bullish from a volatility standpoint as well. So unlike the P&L chart on a diagonal, where once you have your max profit, okay, if you go through the strikes, yeah, you get back a little bit, but then it levels off. You're still profitable, whether that's on the put side or whether that is on the call side. However, in a calendar, that's not the case. If a calendar moves too far away from the strikes, then what happens is all of the premium, all of the extrinsic value left in our long option starts to disintegrate, and a stock can move too far. That's why we don't want Datadog to move much further than it is right now. Okay, does everybody understand that? Does everybody understand that? So again, you see calendar spread P&L here and the diagonal P&L spread here. Okay. Awesome. All right. There's Louis again. I think the wheel is closing. Okay. Mike, how we doing with the how we doing with
if you don't mind
the wheel here? My Sharunas. I love that. You just changed that, Sharunas? Love that. Rolling strategies. Typically, if I do a calendar, a diagonal for earnings, it's usually not the time for rolling. When there is more time between the short and the long, and we can, roll and collect more premium like what we're trying to do in Datadog right now, love the roll. Love the roll. All right. Looks like we got our wheel.
7-9, you care?
Yeah, Mike, way to go with the Winter Wonderland. Love it. Winter Wonderland. All right. Who are we going to get today? Let's give the wheel a roll here. And Winter Wonderland day number 2. Winner is Palmetto Chick Design. I love it. That is a newbie. That is a newbie here. Palmetto Chick Design, are you in the house? Palmetto Chick Design, are you in the house? That would be awesome. There we go. Let's go. Way to go. Congrats. Okay. We're going to put up here an email address for you to shoot me an email to get your swag. All right, everybody, real quick. Any ideas for tomorrow's Market Minds? Any ideas for tomorrow's Market Minds? Anybody? Condors and iron condors. There it is. Condors and iron condors it is. Thank you, Kevin. That will be tomorrow's topic. Wonderful. We can do the calendars compared to broken wing flies, two totally, completely different types of setups. But let's do condors and iron condors tomorrow. All right, everybody. S&P right near the flat line. 69.89 up 1 point on the day. And again, as you could probably see from the lack of activity behind me and the lack of noise behind me, not much going on today. All right, everybody. I appreciate you. Have a happy hump day. We'll see you all tomorrow.